Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Is the 4% rule now the new 4.7 rule? And then we're going to talk about pie charts are us and deniable culpability. It happens even at the big boys, even the hallowed grounds of Morgan Stanley, Bank of New York Mellon, and even Fisher. We're going to talk about that. But I want to ask you, are you a widget for Wall Street's portfolios? Their pie charts are us. Don always says, are you buying rotten fruits and vegetables as a balanced diet? Are you buying rotten sectors and stocks for a diversified portfolio, or are you staying in the best of the best? Okay, so 90% at a minimum, folks, listen to me. 90% of all the advisors out there, are doing the pie charts or us, some asset allocation, target date fund, lifestyle fund, asset allocation with some random rebalancing. And I say it all the time. How do you know that 1 out of 364 5 is the right day to rebalance? What if it sold off 2 months earlier and it sold off 25%? You should have rebalanced or moved earlier, two months earlier. In other words, you should have rebalanced earlier. Don and the team are actually rebalancing on a daily basis as needed. And anyway, but it's probably closer to 98% of all these advisors or pie charts are us. So even the 5 or 6 or 7% that are cloaked as actively managed are really just passive. So we're going to talk about that. So I ask you, what's in your portfolio? What is in your portfolio? And does your advisor have the exact same portfolio as you? When I say exact, I'm talking about the exact same position size, timestamp, and tracking, performance tracking. That's a question. Okay? Now, so I want to know if your advisor has skin in the game, because here at Revere, Don and I, we have all our skin in the game. All right? So anyway, I'm going to go to the mailbag, and then we're going to talk, because all this stuff it ties in. So there's another article in the mailbag. I just put them in there so you guys can read, and I don't put any weight in them or anything. That there's more ETFs than stocks you can put in them. They're currently or now, they just surpassed. They're now, so it's like I got the article, it's in there. It's 4,000 or 5,000 ETFs now. Folks, it's been that way for decades. They were just called mutual funds. There have been more mutual funds and stocks you could put them for decades. So when you had that little pie chart or us and you had 5 different mutual funds, you owned Microsoft 5 different times or 4. And you had, because they were a big stock. So you had them on the technology funds and you had them in the S&P fund. And then so you had them over and over. The opportunistic fund, why don't you, if you really want to own Microsoft, just buy Microsoft, not have the carrying cost. But more importantly, then what's the sell discipline? See, these mutual funds, they have to be fully invested at all times. They can't move to cash within the fund. They've got to stay fully invested. So it's your job to sell the fund, or your advisor. Are they selling the fund, or are they holding your hand? So in any event, that's one article, was there's more stocks than mutual funds to put in them. But even with stocks, if you just own stocks only, like Fisher, ouch. Again, we're going to talk about that. But the 4% rule is now the 4.7. I don't know if the guy's trying to stay relevant or he's just indexing for inflation. Regardless, whether you own stocks, ETFs, or the old horse and buggy mutual funds, if you still have an outdated 401k, you probably have to have mutual funds. But what is the strategy? We want to know the strategy, not the product. Owning 50 stocks or 100 stocks at 1 or 2% each with no sell discipline and no breaks, you're just owning the S&P. So don't act like an active manager and then just hold their hand. All right, I digress. Now, we're going to go to the mailbag, and then we're going to go to Don and the team, and they're going to tell us actually what they're actually doing in the portfolios this week. And when you listen to them, I just want you to wonder, does your advisor sound like that? All right. Now, me. So I got a contact, a message, and I was trying to figure out whether he was trying to sign up for our daily videos or whether he was contacting me for a complimentary portfolio review. And so then he emailed back. So my thoughts, I watched the podcast, impressed with Mr. Vandenbord's discussion, primarily getting back to even. I like the idea of ETFs. He said, Fisher manages my portfolio, significant size. I started with them on 2/5/25. Portfolio, 95 equity holdings. And during late February, early April downturn, the portfolio was down 19%. The S&P was down 19%. That's what I'm talking about. They're tracking the S&P almost verbatim, right in there. When you have that many stocks, you're an index. Anyway, and then back up instead of adjusting down and buying on the upslope. Here is the chart. Maybe I'm too critical. Now, this guy was an IBD guy. He is an active guy and used to manage his own stuff. The reason we went with Fisher is I'm 83 years old. My wife is 65, can no longer manage our investments. I'm definitely going to follow your communication. I'm interested in Revere. And then I said, so he's following Don. He's trying to find Don's videos. I didn't read the whole email. I said, you don't have to go through IBD, Justin, or even Webby or Trader Lion to get Don. You could come straight to the horse's mouth at Revere and cut out the middleman. Then your money will be managed exactly like Don's money, down to the exact same purchase price, position sizing, and overall portfolio tracking. But I have a question for you. If you subscribe to IBD, active management style, how are you with Fisher? Those are two completely contradictory opposite styles, with IBD having active rules while passive Fisher gets clobbered using buy and hope. They do this because, well, of course, the markets always come back. The question is, how long will that be? And do you have time for recovery? Actually, the new science with sequence of returns actually shows that it's better to do it the way we're doing it. Our strategy is the easier, softer way, in my opinion, with higher returns. I will gladly match our returns and drawdowns with Fisher. Throwing the gauntlet down. EB. He said Fisher came back because about my health, but I'm looking for compounding returns and optimizing and stability. Before Monday of this week, I'd never heard of Revere. Now I'm weighing my financial services in light of Mr. Vandenbord's presentation. Most logical is not always circumstantially best fit. So I said, understood. That is a logical answer that makes sense. Thank you for clarifying. Whenever you would like to have a session regarding my services, here's my cell. Call me anytime. I said, by the way, ask Fisher for the same information I provided you. Their trailing annualized 5-year returns coupled with their maximum drawdowns for 2020, 2022, and earlier this spring, and then compare. I can match any date they give you within minutes for an apples-to-apples comparison. Just see how long it takes to get that information back. The reason I know this is it took one of our clients, he was actually came over to us, and he's been with us for years. He was checking us versus Fisher, prodded them for 2 months before finally getting the information to compare against Revere. This gentleman is and was an active trader who supported his family trading before retiring and joining Revere. As he became more retired, he comfortably moved more assets to Revere while doing some trading on his own. I'll be confident he would speak with you. And if you, folks, this is my comment, folks. If Fisher, if you have your money with Fisher, your money, name of our podcast, then ask them, ask those questions, and then let's have a comparative audit. When you started, what's your date? Because it's sequence of returns. It's not Fisher's long-term returns. It's when you started with Fisher. That's your sequence. That's your returns. So let's compare. So I said, if you want it, so I'm throwing down the gauntlet for anybody. It doesn't matter where you are. Morgan Stanley, Maryland, Fidelity, Schwab. They're all going to give you some kind of asset allocation model and tell you that it's all the different allocations. So when it hits the fan, you get protected. Folks, when it hits the fan, all the correlations grow together and it all goes down together, albeit at different rates. The most aggressive stuff gets clobbered the most, but the most conservative still gets hit. You want cash. You don't want, it's all trash on the way down. Now, on the way up, you don't want 50 stocks. You just want the best of the best, 10, 15 stocks and some ETFs. You don't need 100 stocks. You have 93 stocks. Just buy SPLG, a cheap S&P fund, to be done with it. One trade, not 93. Anyway, that's my opinion. Let's find out what Don thinks. Don?
Dan, good segue, because comparing ourselves to other advisors is we're the most transparent advisor, as you said. Our videos every night totally expose us, the good, the bad, and not very often ugly, because we've got sell rules that keep us away from things getting ugly. But two projects we're working on internally I want to talk about. Nobody will outwork us for trying to improve the client experience, the equity curve, cutting edge ways to find additional edges in the market. So two projects we're working on. We talk a lot about earnings gaps up. There's a lot of nuance tied to them, various reasons why they work and why they don't work. We're working on something called Project Maximus, is what we're calling it. And it's analyzing two things. First of all, we want to categorize every market date going back into the 50 years into a category. In other words, what was the market acting like? Because that provides we believe, we're still working on the data, a correlation to the action of an earnings gap up, whether or not it's going to work, or whether or not it's going to flounder, or whether or not it's going to just fail. So looking at the models of these various gaps higher, and it's important to point out why this happens. Reg FD, Regulation Full Disclosure, was passed into law years ago. I don't know the exact year, but it changed the way officials, insiders at a company could communicate with their friends in the financial press. Before, there was a lot of winking and nodding and letting them know, we're kicking butt this quarter. And it was found in the footprints of the stock. Analysts would mention what they thought, but it was really based on insider information. That was canceled, to the threat of you'll go to jail now if you disclose inside information. It has to be made available to the public at the same time. That's what causes Wall Street to be offsides with a lot of these earnings gaps. They are under the impression their financial models show X, and then the results come out and it's drastically different from X, and they have to quickly scramble, get caught up. They want the best stocks in their portfolio as well, so there's people tripping all over themselves and others trying to buy these stocks for the portfolio. So we're matching the action of gaps to the action of the overall market, creating models for what we would expect based on historical action of similar charts. Because really, a chart is just a snapshot in time. There are thousands, tens of thousands of similar pictures going back to the past of what things look like, and they tend to act a certain way. And we're going to put rules to that. That's the first project. The second project is, as far as comparing ourselves to other advisors, the second one is called Project Rex. That Rex stands for Revere Exposed. And what we want is people to send us their portfolios. We show ours every night on video. Send us their portfolios. All we need is the ticker and the percentage of the allocation. We'll run this through our two internal metrics that we use, our volatility adjusted beta and our rebar. So this portfolio should have, in other words, we can compare apples to apples, our portfolio, to people that are considering coming to Revere. Their portfolio, give them an honest opinion based on facts, based on data, give them the tools that we use, apply it to their portfolio, and show how this portfolio that they currently have performed over time versus our portfolios. We think that their decision to come to Revere will be in the data. Some people don't always like to follow the data. You sign all of your emails. Belief in the irrational will never be altered by facts. And there's some people will never win over, and that's fine, but we will still want to present the data as it is and let them make their decision. So 2 projects we're really excited about working on internally. As everything here we do is data driven. We try to remove emotion from everything and go with what the market is telling us. So that's the segue into what is the market telling us right now. I've got the NASDAQ 100 up here, and let me switch to the S&P 500. The calendar rolled over on Tuesday, actually on Monday. It was a holiday, though. That was Labor Day. But the first day of the month, we saw some shenanigans, or did we? The market gapped down. And in fact, in our videos, and internally the team, we said, well, this is September seasonality. It's not a surprise that it gapped down. It's Spitball September, though, Dan. You know how the market throws you curveballs occasionally? Well, this one's spitballs. What's the difference between a spitball and a curveball? There was a very famous pitcher decades ago. His name was Gaylord Perry. He threw the baddest spitball in the history of Major League Baseball. Basically, what a spitball does is he overweights a certain area of the ball with spit, oil, Vaseline, whatever he could hide on his body. Some of the highlights of him going back are really phenomenal to watch, how he would load up the ball. And then a spitball, your fingertips go into it, and it's kind of like a knuckleball. You don't put spin on the ball. So what happens is the spitball coming in is going all over the place, as opposed to a ball that's rapidly rotating. And anybody that ever caught a spitballer or a knuckleballer, the catcher's mitt was huge, because the ball's coming at you and it's going left, right, up, down, because there's no spin on the ball.
Right.
It's moving all over the place. That's the type of market that we're dealing with right now. It's all over the place. It's September. Let's just go back and talk about the last 4 days. And I've got some charts up now. We'll draw some lines. So here's the first day of September, a gap down. Growth stocks have been lagging relative to the market over the past 2 weeks. So we had a gap down here. We actually had a decent cup and handle intraday, and we closed at the high of the day. That was right into the 21-day moving average. That mitigated some of the damage. The next day, we gapped up. This was Wednesday. We came into the lows from the Friday before Labor Day, which was a weekday. That was August 29th. And then we sold off. And then the last 30 minutes, we just shot to the upside for no apparent reason. Again, it's a spitball. It's a knuckleball coming at you. So the next day, mild gap up again, early sell-off, but right to support of the prior day, and then a trend up day, just out of the blue for no reason. We had 2 days of volatility, really 3 days if you count the last day of August, and a smooth trend higher and a strong close. This was going into the non-farm payroll report this morning. The payroll report was weak, but it was a case of the initial perception of the market was that bad news is good news, because the rate of the chance of a 25 basis point rate cut went from 97% to 100%, and actually a 15% chance that we'd get a 50 basis point rate cut in September. The market likes lower interest rates. It's looked at as it is going to benefit the economy and businesses that have debt, because they'll be paying lower interest rates. But this was day 4 up, and it failed miserably, and a lot of volatility came in. We went straight down from 65.30 to 64.40 in an hour and a half. So this volatility, this spitball, this knuckleball action that we're seeing in September does not help an individual. It does not help you if you are a strength-only trader. And honestly, the IBD methodology, one of the rules is M. You have to understand what the market is, because stocks will follow the general direction of the overall market. 75% of them will. Well, if the market is choppy, and IBD is generally a buying strength, buying breakouts approach to the market. But one of those major rules is if the market is not in your favor, don't trade,
Yeah, sit it
because
out.
the
Yeah,
odds are that breakouts are going to fail.
right.
So what did we have last week? Made a new high, a breakout that failed. This morning, made a new high, another breakout that failed. The thing you have to be worried about in this situation is the old saying, from failed moves come fast moves in the opposite direction. So the failed breakout last week led to a gap down. We kind of recovered it. Now, if you are buying strength on the whole way up, and then you get hit with these negative intraday reversals, which happened Tuesday, it happened Wednesday, it happened early Thursday, and it's certainly happening on Friday. This is a very difficult market to make progress in individual names if you only buy strength. We have rules for buying strength and buying weakness. In choppy markets, buying strength is generally taken off the table unless there's monstrous volume accompanying like an earnings gap up, which gets back to Project Maximus again. So we want to know when the odds are in our favor, and based on historical models, what they are expected to do based on what we've seen in history. But Spitball September is making it very difficult to create gains, frankly, outperform the market. We're kind of sticking in line with it, but underperforming slightly this week. But if you go back
Yeah,
to a
but for
bigger
the
picture,
year, you're beating the S&P by the Growth Texans beating the S&P by a couple
yes,
3% or something.
right. But if you go back and look at just even a daily chart, there's hasn't really been any damage done to the market. And that's why we use this index allocation for half of the portfolio to treat it as a foundation. When growth stocks go out of favor, money rotates into value. Well, we catch that rotation because of our index exposure to the S&P 500. And then we wait for those 2, 3, 4 times a year when growth stocks are really cranking. This is when they're cranking. This is when they're cranking. This is when they're not. And in fact, the indexes aren't either. And in a lot of sideways action, which is what we've seen for the market over the past 4 weeks, the index allocation just, it's like treading water along the market, and that's great. Individual names, if you only buy strength, you're getting chopped up. So our approach is to trade less, trade smaller, and move from trading strength to focusing more on buying strength that emerges after a pullback or something at a very reasonable, tight stop. And if it doesn't work, that's probably because the market's rolling over. But it's a lot easier to take a small loss if you buy at support, as opposed to buying a breakout that fails, because you piling up 7% loss one after another will really clip your portfolio. 3% losses because you bought at support and support breaks is a lot easier to handle than 7-8% losses constantly.
Yeah, let me put my Don Interpreter on for just a minute there. So, folks, this is, and for you IBDers, this is what's key. So, look, you could take 10 guys and you could drop Don's brain in 10 guys, and only 2 of them will be any good because the other 8 will get emotional. They won't follow the rules. It's not good enough to. It's not just enough to have rules. You got to follow your rules. That's what makes Don so good. But more importantly, it's also recognizing the market and learning to play the notes in between the it's the feel. So Don realizes this is not a momentum market. IBD is a momentum strategy. Okay, if you're not in a momentum market like just last week, then you sit it out, or you cut your position sizes much smaller when you buy in. You take smaller and then go in. So he's actually adjusted his strategy and moved away from less IBD methodology and more buy the, I hate to say buy the dip because we buy it once it falls and starts rallying up on volume. But all I'm saying, he's buying on pullbacks right now. That's working better because that's this choppy market. In a primary uptrend, you're going to take bigger positions earlier and you're going to go in quick. It's a different market. And that is the difference. And that makes a difference versus pie charts or us. Just buy 20% of everything and just give you a pie chart, leave it, set it, forget it. And then, oh, by the way, we'll rebalance at the end of the year, some random date at the end of the year, we're going to rebalance. So if you got 20, 20, 20, and 20, one drops to 10, means it's lost half its value. You need to ask, why didn't you sell early? Why did you lose so much money? And what they'll do is they'll sell the one that went from 20 to 30 back down to 20, and then they'll add to the one that went down. Sometimes that's picking the flowers to water the weeds. You want to analyze that. Maybe you want to actually add to the one that's going up because the trend's going to continue, and the one that's a dog is going to continue to be the dog. It's the horse and buggy, and it needs to be, you just need to stay away from it. Like emerging markets and international for the last 25 years. If you had sector allocations to emerging markets and in Europe and Japan for the last 25 years, it added risk. It was a dog, and you got pie charted or us's. That's what you got. You were the product. They used you to diversify across all of their clients. Don is managing it to the market and to your portfolio, what you have for those stocks. All right, sorry, Don, I got off on a tangent.
No, I don't know that you did. It followed it up pretty well.
Good.
Pie
Even
charted. You got pie charted our ust. Is that a new
yeah?
Dan
That's a new
saying pie
sniggler. I
charted
just
our
made
ust?
that up. We're just marketing on the fly. Yep.
All right. See if you can figure out how to spell that, Zach.
Well, I can't spell anyways.
All right. So that's where we are in the overall market. We got two very nice presentations today. We're big fans of IBD, and it's not that we're saying that you can't do it. It's in this market. It's recognizing the type of market, using the M that's part of CanSlim, and recognizing the type of your market. You can be in two different types of market at the same time. This is why in our trend gauge we have 3 time frames for the overall market, and then we've got a separate section for leaders, because the market could be holding up fine, but leading growth stocks are not acting fine. And that's it's a very difficult thing, and it takes a lot of experience and a lot of chart reading and a lot of muscle memory for going back to recalling prior times when things worked and when they didn't work. But on the good side, let's take a look at the Russell 2000. This has been, it broke out today. Failed breakout, but look at the relative strength line on this. TurboTaxion has a nice allocation to TNA in here, which is a leveraged small cap index. And they've been taking advantage of that, and it's been doing very well. But we are looking at a possible failed breakout on the Russell. It is still positive on the day. But the bottom line is we've got an outcome for whatever this chart is going to do, because we've got stops. We constantly raise them. We either hit our stop and take a small loss, we pull back near break even and get out for a scratch trade, or we just keep letting the gains go higher and letting the market tell us when to get out. So the first presentation is going to be Connor. He's got a very impressive tool using the relative strength line and the moving average of the relative strength line. I say all the time, no chart is complete without a relative strength line on it. Well, by the time Connor's finished, you're going to say no chart is complete without a relative strength line and a moving average of that relative strength line. So take it away, Connor.
Yeah. This is going to tie into what Don was talking about as well. And basically, I'm going to call this as the relative strength phase. And what Don just alluded to is our whole relative strength is so important to our money management at Revere, because we want to allocate funds into things that are showing RS, not into things that are showing relative weakness. And one way to see that better is having the RS line with the 21 EMA. And Don's got a chart of HOOD up here, And if we go all the way back to April, March, you can see that is when the relative strength phase started. And that was starting when the market was coming out of a correction and the RS line got above the 21 EMA. You had price above all key moving averages. So here, this stock was telling you, I don't want to go down, but the market's going down. And so we call that, the phrase beach ball underwater. So that is when the relative strength phase begun. And we took advantage of that in both portfolios. But you can see this stock has had an amazing run since then. And it was characterized by the RS line holding above the 21 EMA the whole time. So when you see that, you say pullbacks to the 8 EMA, to the 21 EMA, 60-minute stochastics, any tactics that we use for buying pullbacks, when that RS line is above the 21 EMA, the odds of that pullback by working are just much better. And then now you look at the chart of Robinhood now, look how choppy it's been. And you can see that RS line is starting to flatten out and is now below the 21 EMA. And you can see that where it's on pointing that Robinhood pulled back to the 50-day moving average, which is a logical spot for it to bounce. But there was a subtle negative in that, and that is that the relative strength line broke below the 21 EMA. And so it did bounce off the 50-day moving average, but look exactly where that relative strength line rejected, and that was the 21. And then you can see price started to roll over. And again, even yesterday, you could say this is a relatively low risk ad in Robinhood, right? It's sitting at the 50-day, but the relative strength line is much below the 21 EMA. So it really just doesn't make sense. It's not, the probabilities aren't as good. Sure, it could have fallen through today and maybe that relative strength line hooked back up through the 21 EMA. But if you look through a lot of charts, trying to buy pullbacks when that RS line is below the 21 EMA is going to lead to more frustration, more chop. And that's exactly why, reading charts, it's an art, not a science. And you have to analyze all the details and make your conclusion. And Robinhood's necessarily not doing anything totally wrong. It just is likely going to need more consolidation in a base, and trying to buy things in bases can lead to a lot of frustration. So this one is just a perfect example of that. It looked like it was going to fall through off that 50-day moving average, but this was showing relative weakness versus the S&P 500, and it was below that 21 EMA. And now you can see the result of that. It's rolling back over today. So that is Robinhood. The next one is GEV. And this is a very similar example to Robinhood as well. You can see that relative strength phase started in April, March, and it continued. And pullbacks were characterized by the relative strength line holding at the 21 EMA as well. And you can see it continued higher. And then on August 13th, that relative strength phase started to end, and that's when the stock pulled back to the 21 EMA. Still looked nothing overly concerning, just the stock had a big run, probably needs to consolidate, and it did pull back to the 50-day moving average, and it started to bounce back up. And actually TurboTaxation, we did buy that off the 50-day moving average, but I didn't catch this real time, but that relative strength line never got back above the 21 EMA. And you can see, it had a couple days of rallying back up, and then now it's rolling over, and we sold the whole position even from April. And you can see that relative strength line continues to make lower highs below that 21 EMA. So, this tool is really, really good for handling big winners, right? Keeping your expectations in check about where the stock is in the market cycle. It's helpful for that. It's helpful for analyzing, is this a pullback that you're interested in, or is this maybe a pullback that could lead to frustration in a basing period, not in a relative strength phase. And now this, looks like it's bear flagging below the 50-day moving average. So what would make us back interested in GV? Well, first thing would be that RS line getting back above the 21 and basing for a little bit longer. So that is GEV. Another example is Palantir. And I specifically brought this example up because this has been more choppy. Robinhood and GE Vernova, super linear moves. And it never really tested you. But this one, Palantir, has been a lot more choppy. Again, same as the last two examples, it did enter that relative strength line in around April, March, but you can see this relative strength line was a lot more choppy. But one thing that when you look at the whole picture is that these pullbacks, when the RS line broke the 21 EMA, price was also coming into the 21-day moving average, and you can see it would hit that, and then shortly a day or two after, it would reclaim right away. So if you had some good cushion and you're going to be patient, you can see that it never lived below the 21. The RS line never lived below the 21 EMA for long, and it coincided with you at a clean level on the price Palantir as well, and it continued. And then it started to get ominous when it had the harsh break off highs. And that was August 19th was when you saw that RS line convincingly break below the 21 EMA. And that coincided with heavy selling pressure on Palantir, gave back all the earnings gap. So a lot of red flags. And now today, this looks like a bear flag. It's tried to rally back up above the 50 and the 21-day multiple times. And now it's kind of weak again with the RS line below the 21 EMA. So a lot of red flags in this chart. Still, just the likelihood is that this might just need some more time, and it's just not in a position where it's just ready to rip back up to highs and trend. And then for some good examples, BE's one I want to highlight, and this entered its relative strength phase later. This was in a huge base, and you can see just, sideways. And then that July 24th gap was when it really started that relative strength phase. And you can see in a strong trending stock, in a leader that has fundamentals, that RS line is above the 21 EMA. You can see all these pullbacks to the 21 or the 8 EMA were bought up, and that coincided with the RS line moving up really nicely above the 21 EMA. So, you look at this chart, and this is a chart that if this starts to pull back, you have better odds of buying a pullback as it's showing RS, it's a leader, versus trying to buy a pullback in a GEV or a Palantir. And then ITB is the last one I want to talk about. This is home builders. Both Grotection and Turbotection have benefited on this one via Now, which is the 3x ETF. And home builders have just been showing immense RS. And you can see that, this is a bottoming base setup. And you can see August 8th, I would say in August, around August is when the relative strength phase kind of started. And that says it started to come off the lows. And since then, every pullback, it's been bought, and that characterized the RS line trending above the 21 EMA, and it's having a heck of a day again today, breaking out of this kind of cup and handle base. But again, the way the RS line is acting on this one, the expectation would be if this starts to pull back, pullbacks would be supported as it still is in a relative strength phase. So that is the relative strength phase. It's just such a helpful tool for managing a winner, deciphering if you want to buy a pullback, and just really trying to focus on the best merchandise, because that's our goal at Revere. We want to allocate the capital to the best things that are going up in the market, and relative strength line is your best friend for identifying that. And this 21 EMA just adds, just paints a better picture sometimes than just using the RS line, which we do, but the 21 EMA kind of makes it a little bit easier to see.
Great stuff, Connor, and a big hat tip to Mike Webster at IBD. He was the driving force behind getting this relative strength moving average added to the market surge charts, and it's a great tool that we use, and we'll be making greater use of, always being aware of it going down the road. All right, Todd, not all pullbacks fail. Some of them find support where they should if they were going to continue to lead or start a leadership phase. You got a couple of charts you want to show us that followed that model, so take it away there.
Yes, and this is a good segue into what Don was talking about earlier. When we get into a more choppy environment, this is a nice technique to help improve the odds of staying with a good entry and having less of a chance of getting stopped out. So we're going to look at a few examples of stocks that pulled back to the 50-day moving average and displayed strong relative strength quickly after that test. And CRDO is a great example of this. Connor brought up several examples where they have been sitting on that 50-day moving average, but haven't had any meaningful bounce. And Bill O'Neill used this technique to add on to winning positions as well as enter positions that he may have not gotten into. And he didn't simply buy right on the 50-day moving average because the stock hit that average. He bought on strength from the moving average. And you can see this move down to the 50-day on CRDO. What happened is it was a rapid bounce with a close at the high of the day on the test. And that's exactly what you want to see, that strength. Now, the relative strength line at that time had fallen below the 21-day moving average, but you want to see it quickly recover and get back above that and see progress. But in this case, this is a great example because it was a furious sell of 22% down to that, but it quickly regained itself and gave you quick feedback that it was a strong bounce. The next name that worked out very nicely is Seagate. Or we can go to CLS. So this is another great example of a quick intraday test of that 50-day moving average. And this is exactly what you want to see. No time wasted languishing on that 50-day. Quick reversal back up, and the relative strength line stayed really positive and rode that back above. So pretty simple, pretty straightforward, quick feedback, and then a breakout. And now let's look at CLS. Again, these are all stocks that have been on the 21 over 21 list, the weekend review watch lists. And, all we're doing is observing and waiting for opportunities to get into some of these. And here's another example of the same situation. Strong relative strength, bounce off that 50-day, and it didn't languish. So I screen, and I've built a screen to look on a daily basis of anything coming down to that 50-day to see if there's any names that look actionable. Currently, there isn't a whole lot of names that look great at the moment. Maybe CCJ, but the CCJ's kind of languishing here as well. But it's still above the 21-day moving average on the relative strength line. So it could be a name that we see if it does show some strength coming up. But there's really not a lot right now that's showing that relative strength. And I wish I could show some examples. But right now, the strength is in the rotation of the market. And that's what we've been talking about for a while. So that's all I have. Thanks, Don.
All right, Todd, Dan, that's all from the tech team. You can take us on home.
Folks, listen, if you like what you heard, please tell a friend, tell a neighbor, and this is your money, not Wall Street's money. It's not their money, it's your money. And we manage your money exactly like we manage our own money. My wife's money, my mother's money, my family's money, Don's money, the employees' money, everybody, especially Don and I, same price, same timestamp. There is no difference because we all are all in. So do you have a sell discipline, or are you getting sold products because you're the cattle, he's the rope, or he's delivering you to the market? He's taking your money and diversifying it all across his real clients, the municipalities, the emerging markets, the different stocks and bonds, all the rotten fruit and sectors, along with some good ones. Why not just focus on the good ones and leave the rotten ones behind? Folks, go up to our website, subscribe. You can also contact us for a complimentary portfolio review, and you can always call us old school at 855-REAL-WEALTH. We'll talk to you next week on Your Money, not Wall Street's money, your money.
Because it's not about how much you make in the markets, it's about how much you can keep.